Good afternoon, everyone, and welcome to the Frostrow Healthcare Investor Webinar. We're just waiting a few more moments for the system to admit all of the participants. In the meantime, I'll quickly run through some admin points. If at any point during the call you have issues or you drop off, please email distribution@frostrow.com and we will assist you. We will distribute the presentation slides after this call, and there will also be a recording made available. The format of this afternoon's call will be presentations from Worldwide Healthcare Trust and the Biotech Growth Trust, and this will then be followed by a Q&A session. At the bottom of your screens, you should be able to see three icons: chat, raise hand, and Q&A. Please use the Q&A button, submit your written question at any time during the call, and these will be answered shortly after the presentation. If due to time, we can't get round to answering all of the questions, or you have any further questions for the team, please feel free to follow up and email distribution@frostrow.com. As you will have seen, it's been a particularly volatile period for the wider healthcare sector, with valuations now looking increasingly compelling. I will now hand over to Sven Borho to speak in detail about the healthcare sector and the outlook for the future. Thanks, Sven.
David, thank you so much for the introduction. Well, good morning, everyone. This is Sven Borho. I am the managing partner of OrbiMed, and I'm a co-portfolio manager together with Trevor of the Worldwide Healthcare Trust. On behalf of OrbiMed and my team, I want to welcome all of our shareholders to our 2022 joint annual presentation for the Worldwide Healthcare Trust and the Biotechnology Growth Trust. I have with me on the call two partners, Trevor Polischuk and Jeff Xu. Trevor is the co-portfolio manager of the Worldwide Healthcare Trust, and Jeff is the portfolio manager of the Biotechnology Growth Trust. In addition, we have the head of ESG at OrbiMed here on the call, Priya Malenabur. We are very excited to have her for the first time on this on our call. Now, the agenda for the call, in the first, I will give you a brief update on OrbiMed and the current state of the healthcare sector. I will then hand it over to Trevor and Jeff to discuss the fund specifics and some of the most important investment themes for 2022 and beyond. We do realize that ESG is becoming more and more important to our UK investor base. This is why we have Priya on this call to introduce our investors. How do we implement ESG here at OrbiMed? Okay, coming to the OrbiMed corporate update. As an organization, we are right now right around $17 billion US dollars, very healthy, very healthy level with good flows here inside our funds. There will be very good growth actually in the coming months through a couple of new raises on the private side. As you see here, our assets are split roughly 1/3 public equity, 2/3 private equity, venture capital funds. The Worldwide Healthcare Trust is our true flagship fund. It's our largest single fund in the organization. We have approximately $3 billion assets under management there. Another very important fund for us on the public equity team is the Biotechnology Growth Trust with $700 million assets under management. I highlight here on the page that we have a total of 130 employees. This makes us the largest investment team dedicated to a single sector. I think this is the most important factor for our long-term success. We have over 30 people with advanced degrees, MDs, PhDs, and we have 15 team members who were previously CEOs of biopharmaceutical companies. Over the past 18 months, we hired 25 new employees, including an additional 8 team members on the public equity teams. So we have now several new team members in pharma, emerging biotech, emerging markets, both in India and in Hong Kong. Now, on the portfolio management team side, nothing has changed. Trevor and we are the co-portfolio manager of Worldwide Healthcare Trust. Jeff is the PM of the Biotechnology Growth Trust. And I think you're all very familiar with the three of us, as we share all of the communications responsibilities with our shareholders. But obviously, this is not a three-man team. We have the full support of the full OrbiMed public equity team. And we have a very, very strong team, not only in biotech and therapeutics, but as well in non-therapeutics, in medtech, in services, and in emerging markets. I think we have an excellent emerging market teams. And obviously very excited to have a fully fledged ESG effort as well, which is headed by Priya. Now, we are actually fully back to work from the office since last fall. All of us are sitting right now in the office. We did take a quick break when Omicron peaked here in New York, but in the third week of January, we're fully back. So everything is back to normal here at OrbiMed, and fingers crossed, we have seen the end of the pandemic. Now, this slide is a good illustration of the commonalities and the major differences between the Biotechnology Growth Trust and the Worldwide Healthcare Trust. As you all know, Worldwide Healthcare Trust, very diversified fund, both by geographic diversification and by subsector diversifications. We have important holdings in biotech, pharma, and especially pharmaceuticals, but as well, medtech, very, very important part, life science tools, and services, very diversified. Biotechnology Growth Trust, obviously very focused on the innovative end of our sector, with emerging biotechnology companies being the lion's share of the fund. But the common themes between both funds is we believe in innovation and in growth. We want to be in the most exciting names inside the healthcare sectors. And the overlap between BioG and Worldwide Healthcare Trust is, for example, in emerging markets and in some of the emerging biotechnology names. We do utilize in both trusts as well private crossover investments in companies which are about to go public within the next 12 to 18 months. Now, coming to performance, and we do have some explaining to do. Our fiscal year ending in March 21 was a fantastic year for both trusts, one of the best years in the history of both trusts. This was a year where company fundamentals really mattered. It was where terrific growth and innovation companies were getting recognized in the stock market. For both trusts, emerging biotechnology names, and especially Chinese emerging market names, were the key drivers for the good performance and significant outperformance over the benchmarks. But unfortunately, there has been a dramatic U-turn in performance during the current fiscal year. And everything that worked in 2021 did not work in the current fiscal years. During that year, fundamentals did not matter. Everything was driven by macro trends. And it's like, for example, a big shift from growth into value. So if you were a high growth company with a lot of innovation, you sold off heavily last year. And in particular, two sectors that drove the performance in 2021 were actually hurting our performance in 2022. This was, again, Chinese in emerging markets and emerging biotech, the emerging biotechnology sector. And let me explain a little bit the backdrop for both sectors. So what happened here in the fiscal year? You see here the emerging biotechnology names almost at the end of the 2021 fiscal year. We saw a big bear market starting in biotechnology. And this has been a bear market of historic proportions. I've been in the sector for 30 years. I have never in my professional history seen such a dramatic underperformance of the emerging biotech sector vis-a-vis this S&P fund 500, or actually like broad healthcare benchmarks like the MSCI Worldwide Healthcare Index. So the underperformance was 64%. The absolute drawdown was historic as well, close to 50%. And as well, the duration, it's the longest lasting biotechnology bear market in the history of the sector. And if you go to the next page, this is a very interesting statistic as well. if you would have bought emerging biotech, as here represented by the XBI ETF, in the summer of 2015, you would be right now flat. And this contrasts with the S&P being up more than doubling over the same period. So in the past 7 years, we have seen incredible fundamental change and innovation. But the stock market, it's not reflected in the stock market since we are in this biotechnology bear market for the past 12 months. Very similar situation in emerging markets. Here you see performance of the MSCI World Healthcare Index, and then you have the Hong Kong Chinese healthcare names. So you see there as well, the bear market started in the summer, not like biotech in February of last year. It started in the summer, but really dramatic underperformance. And unfortunately, those two subsectors where we have heavy overweights, both in the Worldwide Healthcare Trust and in the Biotechnology Growth Trust, they're highly correlated. Typically, emerging markets and biotech don't necessarily correlate, but during this current fiscal year was an extremely high correlation between the most innovative high growth sectors. Now, where does this leave us with valuations for the healthcare sector? Everyone is worried about the bubble of everything, with markets, even after recent pullback, at relatively high valuations. Well, healthcare is trading, and this includes all of the major caps as well, trading at an extremely healthy discount. So we are trading at a 20% discount to the S&P. This is almost the same discount as we had during the financial crisis in 08-09, when we had Obamacare on the horizon, and an even larger discount when another major healthcare reform was on the horizon, 93-94, Hillary Care. We are as well on lower valuations than we were at the end of when the Nasdaq bubble burst in 2002. And every single time when our sector has been trading at such a discount to the market, those were always the very, very best times to be in healthcare and to be in innovation and growth inside the healthcare sector. So despite the very, very challenging current fiscal year, Troy, maybe go to page 11. We are very confident, that we were able to recapture some of the lost ground from the current fiscal year in the coming months. We are going to give more details on all of those points. But most importantly here, we think some major overhangs are lifting. We've seen a new FDA commissioner in place. Drug pricing reform is probably off, is no longer happening. We're very confident that here in the second quarter, we see a spike in biopharmaceutical M&A. We are very confident as well, that we see a bounce back in emerging biotechnology in emerging markets. They have been in a too long of a bear market. And we are very confident that we do have the right strategy with investing heavily in a highly innovative, high growth medtech and tools companies. What we are doing in this challenging environment is we are allocating fresh funds into the most dislocated stocks. So we are constantly looking here what got most dislocated in this market environment, and we are putting more money to work. So we are very, very busy on the trading side, both in Biotechnology Growth Trust and the Worldwide Healthcare Trust. With that, I hand it over to Trevor, who will talk about Worldwide Healthcare Trust.
All right, thank you, Sven, and good afternoon, everyone. Good morning from New York City. In this section, my main goal will be reviewing the recent performance for the Worldwide Healthcare Trust for the current fiscal year. But first, let me go back a little bit further, 2 years, in fact, to 2020 and our fiscal year ending March 2021. And Sven alluded to this a little bit already, but this was really one of our best years in the company's history. Recall that fiscal year literally started right after the historic drawdown in March 2020 when the pandemic first began. And that turned out to be a very astute buying opportunity for the Worldwide Healthcare Trust. because this was followed by the V-shaped recovery in April, where our fiscal year actually commenced. And our pandemic playbook that we instituted in March of that year worked extremely well. And there's a lot of parallels to today, where we were looking for the most extreme dislocations in the portfolio, focusing our best ideas, reducing name count where possible, and increasing the overall quality of the portfolio during that time. And this is where we really started to outperform in that fiscal year. And it's important to note, as Sven mentioned, stocks that year really traded on fundamentals. Innovative names worked, the catalyst strategy worked, biotechnology outperformed in the halo of COVID, the IPO market was strong, China healthcare rallied. But now let me turn to the current fiscal year. And it has been basically the complete opposite. You know, stocks have really been macro-driven, factor-driven, quant-driven. You know, earlier in the year, we had the Reddit trade, the reflation trade, the momentum trade, then the recovery trade. And as Sven alluded, we moved to a risk-off environment, the growth to value trade, we had the inflation trade, the interest rate trade, and now we even have the wartime trade. Fundamentals have not mattered whatsoever during this fiscal year. And in turn, it's been one of the worst fiscal years for us. It was exacerbated here with the turn of the calendar year, with the rise of the geopolitical tensions in Eastern Europe. And I think importantly to note that for healthcare to really work, there has to be an understanding and appreciation of the fundamentals of healthcare by the generalist investor. So this market environment has been a complete mismatch really to our investment style. Moving to slide 15 here, this slide shows where we generated the returns in the fiscal year ending 2021. And as you can see in this graph, all sectors were positive on an absolute basis, but the real drivers were our key overweights of emerging biotech and China healthcare, which generated the largest absolute and relative returns in that period. We also did very well in tools, owing to the innovation cycle that's going on there and our stock picking within that sector. Slide 16, however, shows where the pain really was for the current fiscal year. Clearly, the largest negatives have been biotechnology and China, still our two key overweight positions. Tools as well has been a struggle as we've been a little bit wrong-footed there compared to 2020. But we've made some positive returns across pharma, India, devices, services, but has not been enough as our two key overweights have been the largest source of negative performance in the current fiscal year. Another interesting point of reference in this slide is shown in the box here, that 100% of the move in our benchmark has been fueled by large cap stocks, which we are underweight in the current portfolio. And I think this kind of shows that this year's been all about positioning rather than fundamentals or stock picking. Again, a mismatch to our investment strategy. This slide shows our relative weighting across subsectors, and I'll just be brief here. I wanted to point out three separate things on this slide. First, our underweight in large cap pharmaceuticals. This is due to a variety of reasons. One, owing to the weighting in the benchmark. Two, the heterogeneous nature of these companies, where we've seen many have and have nots. So we remain very selective in the space and remain underweight large cap pharma. But overweight emerging biotech, we are sticking with that strategy despite the volatility of this past year. We really believe the fundamentals in the innovation cycle are as good as they've ever been and now can be bought at distressed prices. And we'll continue to be overweight emerging markets as we think really, quite frankly, China healthcare is oversold here, despite the multitude of headlines and uncertainty it's created over the past 6 months. Finally, this slide shows the performance of the company since inception. And specifically, this slide shows our NAV versus our benchmark versus the broader market, here represented by the FTSE All-Share. And I think this slide shows a few things. First, it puts into context the drawdown of the current fiscal year, which we have just experienced, and it shows other drawdowns that we've bounced back from previously. Second, I think it shows that exposure to healthcare in your portfolio is really a must. The outperformance versus the broader markets over the past decade or so really coincides with many of the tailwinds for the industry that still exists today, primarily innovation. And finally, I think this graph unequivocally shows that an active manager in healthcare can really outperform the benchmark, given the highly idiosyncratic nature of this industry, especially in the therapeutic space. With that, I will turn it over to Jeffrey to discuss the Biotech Growth Trust. Jeffrey?
Great, thank you, Trevor. So I'll now talk about the Biotech Growth Trust. So as Sven outlined earlier in the presentation, if one looks at the prior fiscal year, the Biotech Growth Trust had an outstanding year in the fiscal year ending March 31st, 2021. The NAV was up 55%, well outperforming the performance of the benchmark index, the NASDAQ Biotech Index, by about 30 percentage points. I would say the biotech sector was very resilient throughout the COVID-19 pandemic, and really the fund was very well positioned to capitalize on the growth and innovation in the sector. Turning to the next slide, though, this year we've seen a reversion of that performance. It's been a much more challenging year. And as Trevor alluded to, it's really been due to a lot of macro factors. So we've seen general market weakness for high growth biotech companies. We've noticed a market-wide shift from growth to value. There's been a notable size divergence where small cap biotech has significantly underperformed large cap biotech. And I'll get into more details on that in a moment. And then we've also unfortunately seen a pullback in emerging markets, in particular China in the second half of 2021 did see a market-wide pullback due to fears over Chinese regulatory tightening. And so those were significant headwinds to the performance of the fund for this fiscal year. If we turn to the next slide, I think the principal reason for the negative divergence in performance versus the benchmark for the current fiscal year really comes down to small cap biotech underperforming large cap biotech. If one looks at the market cap makeup of the Biotech Growth Trust in the table at the bottom of this slide, what we've done here is classified the holdings of the Biotech Growth Trust into three market cap categories: large caps above $10 billion market cap, mid caps between $2 and $10 billion market cap, and small caps defined as less than $2 billion of market cap. And we've juxtaposed that market cap distribution versus the NASDAQ Biotech Index, our benchmark index. And you can see in the last column of that table that basically the Biotech Growth Trust is significantly underweight large cap and overweight small cap versus the NASDAQ Biotech Index. Now, unfortunately, if one then looks at the average stock performance of NASDAQ Biotech Index securities in each of those market cap categories, we can see in the graph here that small cap stocks shown in the light blue line significantly underperformed large cap stocks shown in the black line at the top by close to 30 percentage points during the current fiscal year. And that really contributed to a significant headwind to performance structurally for our fund. If we move to the next slide, I would also add that this small cap underperformance really happened across the whole market, across all industries. So it wasn't actually biotech specific. It really occurred across industries. On the next slide, another way to look at the drawdown that we've seen recently is to take the XBI, which is an equal weighted biotech index that is commonly used as a proxy to look at small and mid cap biotech performance, and look at its relative performance versus the S&P 500, which of course is a proxy for the general market. So the first thing that we see here on this graph, plotting the relative performance between those two indices, is that since 2006, biotech has generally outperformed the S&P 500 for the past 15 years. So biotech generally has been a good sector to invest in. But of course, during this time frame, there are periods of relative underperformance versus the S&P 500. And we have highlighted a number of those periods here with the red circles on this slide. So these are periods of relative underperformance versus the S&P 500. Here you see a 31% drawdown in 2014, a 44% relative drawdown later on, a 30% drawdown. And then here on the right, you see a massive 64% relative drawdown versus the S&P 500, the longest and most severe drawdown we have ever seen versus the S&P. Now, the great thing, or the optimistic way to look at this all, is that after every single one of these drawdowns historically, we have seen a very robust recovery period where the XBI actually significantly outperforms the S&P 500. And we think we are overdue for that recovery now that we've had this unprecedented record drawdown versus the S&P. So that makes us very, very bullish on the sector. If we turn to the next slide, another way to look at this is just to plot the annual returns of the XBI since 2007. And that's what this graph shows here. And again, one will note that in general, whenever the XBI has a negative performance year, the following year generally is a strong performance period for the XBI. So here on the very right, in 2021, the XBI had its worst annual return ever, down 20%. And so we think if history repeats itself, 2022 should be a much stronger year for the XBI. Turning to the next slide, I've talked a lot about sort of relative performance of the biotech sector versus the general market. How do absolute valuations look right now in biotech? And I would argue they're actually at 20-year lows. I've been in this business for about 20 years now, and I've never seen the sector as cheap as it is now. And one, I think, very objective way to look at valuations, especially of stocks that are not expected to have profits for quite some time, is simply to compare the market caps of those stocks versus the net cash on their balance sheets. So it's very objective. It's not dependent upon estimates of probability of success of assets or future revenue projections, just looking at market caps versus the net cash on their balance sheets. And if you plot the percent of biotech companies now trading below net cash on the balance sheet on the left-hand side, you see that we are at a 20-year high. About 16% of the biotech universe now has market caps below the cash on their balance sheet. About 1 in 6 companies now trading below cash. This is really a dramatic valuation contraction that we've seen in the sector. Now, because we have had a number of biotech companies go public in the last 3 to 5 years, we had a very strong IPO market. If you translate that to the number of biotech companies now trading below cash, you can see on the right here that it has spiked tremendously. We now estimate over 90 companies are now trading at market caps below the net cash on their balance sheet. So we think a very, very compelling valuation case can be made for emerging biotech at the current time. Next. So another concern that we've heard recently from investors is concerns about the rising interest rate environment in the United States. Of course, inflation is picking up in the US. The Fed has made it very clear that they intend to raise interest rates to combat that inflation. And so people are wondering, is that going to have a significant negative impact on biotech, especially emerging biotech that is currently unprofitable and may not have positive cash flows until far in the future? Well, interestingly, Cowen actually did an analysis. They're a US investment bank, and they put together this graph, which we've reproduced here, where they looked at interest rates. Here, the 10-year treasury yield shown here in gray since 2006, and they plotted that against the XBI shown here in blue. And the shaded portions of this graph indicate periods in which interest rates were rising. And you can actually see that there is actually very little correlation between XBI performance and rising interest rates. In fact, there are many situations or times here when interest rates were increasing and the XBI also increased. So our view actually is that the fears of the impact of rising rates on biotech are really overblown. And we do believe that biotech can still perform in a rising rate environment. Next, Trevor. So the last thing I wanted to sum up with regards to the Biotech Growth Trust is really to emphasize the fact that this particular fund is really structured to capture the innovation going on in the sector. And fundamentally, we're still seeing great innovation in biotech. Over 40% of the portfolio consists of companies that we define as working with novel drug development technologies. We've listed a number of those technologies on this page, along with the percent NAV exposure of the fund to those particular technologies. So whether it's antibody drug conjugates, gene therapy, cell therapy, multispecific antibodies, oligonucleotide therapeutics, or liquid biopsy. All of these technologies, we think, are still in the very early stages of reaching their full value potential and should drive significant value for the portfolio over time. So with that, I'm now going to turn it back to Trevor, who's going to discuss some of the high-level investment themes for the sector. Trevor?
All right, thanks, Jeff. To kick things off, I would like to discuss all things FDA. And I think this has been a very important talking point throughout 2021, that there's been a growing concern from many generalist investors that things have slowed significantly at the agency. And while I acknowledge the pandemic has materially stretched the resources at the agency, I don't think that this concern over slowdown is accurate whatsoever. First and foremost, the FDA response to COVID-19 has been an unprecedented success. Multiple vaccines approved, multiple COVID therapies approved, including two more recently, two oral antiviral therapies from Merck and Pfizer respectively, and countless diagnostic tests have also been approved. Second, we have not seen a material slowdown in new drug approvals, oops, sorry about that, whatsoever. In fact, over the past 5 years, it's been the most productive in the agency's history, including this past year. Third, another investor concern I keep hearing is how risk averse the agency is, yet we had an Alzheimer's drug approved for the first time in 20 years last year, albeit with some controversy. But most importantly, I think the idea that the FDA was a rudderless agency was due to the fact that the FDA had been without a commissioner over the past year, really since President Biden took office. I think this is rather a baseless claim, but nevertheless, we've just had a new commissioner approved. His name is Dr. Robert Califf. He's a world-renowned cardiologist. He was the previous commissioner under Obama. But most importantly, I think he's viewed as very industry friendly. So I think a win-win here. But most importantly, going forward, we think investor perception of the FDA is going to improve immensely, lifting what we think is a key overhang on the sector. Another overhang on the sector, and Sven discussed this previously earlier in the presentation, but is this ongoing threat of prescription drug pricing reform in the US for seniors. And this has been an overhang on the group really since late 2020, when Biden took the White House and the Democrats controlled the rest of Congress. And we had been optimistic throughout the year that there would have been a resolution to this issue by now. Even last fall, there seemed to be enough Democratic support to get a very watered down proposal passed within Biden's Build Back Better plan. You know, we had viewed the passage of this plan as potentially clearing event for the sector, as it was very industry friendly. But after an influential senator withdrew his support, once again, the Democrats could not even get this bill to a vote, even to this day. And now, with war breaking out and the geopolitical tensions escalating, I think the Biden administration is completely focused on other matters. So we expect this bill to likely fade away, especially as we approach midterm elections this year. There's just no attention being paid to it. So hence, I think the threat of any drug price reform will totally dissipate in the near term, lifting another important overhang on the sector. Next, a few words on M&A. You know, we're always optimistic about the possibility of M&A in the biopharma space, but there are ebbs and flows that impact the pace of M&A at any given time. But as I listened intently through the fourth quarter reporting period that has just ended, I was really struck by some of the profound messaging from the large cap pharma execs about business development. And to be quite honest, I don't recall such table pounding on M&A before. Even so, they included many specific comments about it in their quarterly slide decks, which I've never seen before. But the messages were all basically the same. M&A is a top priority. We need to do more M&A. We're looking for best in class, first in class, breakthroughs. Overall, I think these talking points are really a harbinger of things to come and could be a real rallying point, especially in biotech, as we've seen in the past, that an inflection of M&A can really float all boats. And maybe with a nod to what they might be buying, I'll turn it back to Jeffrey.
Great. So I've talked about why, from a valuation perspective, we do expect a rebound in emerging biotech. But I really want to emphasize the point that fundamentally, what's going to drive value in the sector is the innovation coming to fruition. And we still very firmly believe that we are currently in a golden era of innovation right now in biotech. And that's illustrated in part by this graph at the top of this slide that shows the number of FDA approvals of first-in-class drugs each year since 2017. So these are drugs that have a completely new mechanism of action. And you can see that since 2017, we've seen a steady uptick in the number of first-in-class drugs approved by the FDA. On the bottom half of this slide, we've noted a number of innovation milestones for the sector. So back in 2017, the FDA approved the first CAR T cell therapy for cancer. They approved the first gene therapy for a rare eye disease. 2020, of course, we had the advent of the new mRNA COVID vaccines. mRNA had never been used as a platform technology for vaccines previously. And in record time, we had these two very, very effective mRNA vaccines for COVID. And then last year, we had a dramatic advance in the gene editing space, where Intellia Therapeutics announced some very encouraging data for their in vivo gene editing therapy for TTR amyloidosis. This is an administration or a drug that will allow potentially a functional cure for these patients with a single administration. So very, very exciting happenings going on in innovation in biotech. Fundamentally, we think that the sector is still very, very strong, and we don't think the recent drawdown in stock prices really reflects the innovation going on here. On the next page, turning to emerging markets and China, we also expect a rebound here as well. Most of the biotech innovation historically has occurred in the US and Europe, but we think China is rapidly catching up. If you look in the upper left-hand corner of this slide at the number of novel drug approvals in China in the past 5 to 6 years, you will see a steady increase in the number of novel drug approvals in China. In the upper right-hand corner, we also see a number of examples of Western biopharmaceutical companies in licensing innovative assets from Chinese biotech. That would have been unheard of 10 years ago. It is proceeding apace, and we expect actually to accelerate over the coming years, and represents tremendous validation for the state of innovation going on right now in China. And then lastly, the Chinese government has really, if you could turn to the Chinese government, Trevor, the previous slide, yeah.
Oh, yeah.
The Chinese government has really made a priority to develop a domestic biotech industry in China. So it's in their official pronouncements, their official 5-year plans, and so forth. And so the Chinese FDA has really undertaken some reforms, most recently in the middle of 2016, where they are actively expediting the approval of innovative drugs in China. So if one looks at the median approval timelines pre-mid-2016 versus post-mid-2016, you'll notice a significant acceleration in the approval timelines of these drugs. So all of the arrows really point to significant innovation rising in China. And we believe, because we have a strong local research team with analysts in Shanghai and Hong Kong, we are particularly well positioned as a firm to capitalize on this innovation trend. Next slide. So lastly, I just wanted to highlight some of the stocks that are held in one or both of the trusts where we think the stock prices really have been dislocated from their fundamentals. So here is a slide showing various stocks, and in red, it shows the percent stock decline since the 52-week high for that security. You'll notice a lot of these declines are in the 60 to 70% range. So massive drawdowns in a lot of these companies. We believe the fundamentals of a lot of these companies are still very, very strong. These are high growth, innovative companies, and we have been selectively adding additional capital to certain of these companies. We do expect them to rebound quite nicely when the rebound in healthcare broadly does come about. So we're still very, very excited about the innovation potential that's embedded in the portfolio, and we'll be adding additional capital to the names that we think are going to rebound the most in the recovery. So with that, let me now turn to Priya Malabanur, who is going to talk about our firm's ESG strategy. Thank you.
Thank you, Jeff. Good afternoon to everyone on the call here today. I am Priya Malabanur, and I head ESG at OrbiMed. Over the next few minutes, I will take you through a brief overview of our approach to ESG and present a snapshot on how we integrate ESG in our investment processes. At OrbiMed, we believe that there is a high congruence between companies that seek to act responsibly and those that succeed in building long-term shareholder value. This belief guides our ESG approach. In order to bring this into practice, we've developed a robust framework on ESG with a well-defined policy on responsible investing, designating a role dedicated to ESG, and continually building capacity through regular trainings on ESG. Turning our attention to the next slide, with this robust framework in place, we have taken steps to integrate ESG across the investment cycle as follows. First, we negatively screen businesses that objectively lead to negative impacts on public health and well-being. For example, we do not invest in businesses that manufacture, market, or distribute banned or illegal pharmaceutical products. Second, our due diligence process includes a review of financially material and relevant ESG factors pertaining to the healthcare sector. Some of the material ESG factors include review of drug safety, potential to advance access to medicine, review of human resources policies, and others. Once we make an investment, we regularly monitor the performance of the portfolio companies. Our analysts review information on material ESG factors, such as results from clinical trials, review of drug safety data, etc., on a regular basis. We also monitor ESG alerts and review ESG disclosures by companies regularly. We also engage with companies on relevant ESG topics on a regular basis, including through meetings with management, proxy voting, ESG conferences, and our very innovative industry investor ESG meets. We are also in the process of introducing a quarterly report on ESG to provide our investors an update on key developments in the sector, highlights from our portfolio, and on engagement initiatives with our portfolio companies. I'm also excited to share that OrbiMed is at the forefront of leading meaningful ESG engagement in the sector. As we all know, ESG is a rapidly evolving field. OrbiMed is pioneering ESG engagement initiatives to bring the industry and investors together through dialogue and exchange of leading practices. I'm very pleased to share that we're hosting the first such industry investors meet next week for the large cap pharmaceutical sector. We're working with our partners, AllianceBernstein, to organize this engagement. At this meet, we seek to bring together ESG heads of large pharma companies, healthcare analysts, and experts from Bernstein and other investors, such as ourselves, to share ESG expectations and challenges. With this, I come to the end of my presentation. I will be happy to take any questions on ESG during the Q&A segment. I now hand over to Sven to discuss our playbook for 2022.
Thank you so much, Priya. So I'm going to just sum up our presentation here at the very end. You know, there are a lot of gyrations here in the macro environment. Obviously, with the unfortunate event in Eastern Europe, they have an impact on the stock market. But when it comes to healthcare, you know, healthcare is very, very little impacted by whatever is happening right now in Europe. You know, we will always need, despite of what's happening in Europe, everyone still needs their cancer drugs, still needs their medicine. So our sector is very, very immune to some of the bigger micro gyrations, which are really impacting the market. And so despite all of this, I'm very optimistic about the next years. You know, I think we have shown you that this is an incredible opportunity right now for the healthcare sector. So many of our most favorite positions are trading at incredible dislocated valuations. You know, we can buy so many biotech names now at a discount to the cash on the balance sheet. And the fundamentals are as good as they have ever been. You know, innovation has marched on. So we will not change the key recipe for success, what we had in Biotechnology Growth Trust and Worldwide Healthcare Trust. We will continue to invest in the most innovative, highest growth opportunities inside healthcare. This part of the strategy will continue to be the key to recipe for success in the future. Now, we are very active right now in this environment. When you see so many dislocations, you reposition the portfolio. So we're extremely active right now with trading and taking advantage of the opportunities presented in the market or volatility. I think we have shown you that a number of the key overhangs are actually finally lifting for our sector. And I'm very optimistic about M&A starting to really creep up here in the coming weeks and coming months. You know, as always, we will use gearing in a tactical fashion. You know, we are not fully geared in either one of the funds. We have powder dry to put more money to work. And it's very important. You will not be able to buy these bargains when everything starts going back up again. You have to buy them on the way down. But overall, you know, given the length of the bear market, what we have seen actually in some of these healthcare names, I'm really bullish here on the coming 12 months. And with that, I would open it up to questions. I think we have already 8 questions in the queue. David, do you want to moderate it and read some of the questions?
Yeah, not a problem, Sven. So first question, what opportunities do you see from the greater use of data in healthcare?
Okay. Jeff, do you want to answer this one?
So clearly in the drug development process, we're seeing some market advances in the use of data to help accelerate and make that process more efficient. So we do have a number of artificial intelligence companies out there right now, and a lot of biotech and pharmaceutical companies are actively engaging with those particular providers to enhance their drug development efforts. So that very much is, I think, a nice tailwind for the sector in terms of, you know, using data to both discover drugs and better design their clinical trials and so forth.
Yeah, I could add something to that too. You know, it's been really interesting over the last 6 months with all of the large cap pharmaceutical companies discussing pipeline opportunities, and the use of AI, as Jeff alluded to, has become sort of commonplace across all of the big companies. It is turning out to be a great discovery tool and has really reinvigorated and continued to propel the innovation cycle going forward.
Thanks, Trevor. Does the sector have many supply chain issues?
Yeah, I can start with that. Sorry. You know, this is an interesting question because we first started asking these questions in March of 2020. When the pandemic began, that was where all of the questions were in large cap pharmaceuticals, given the global manufacturing footprint of all of those companies in that particular space. And really, we have not seen any material, significant, or notable supply chain issues, at least across large cap pharmaceuticals on a global basis. Really since March of 2020 to today, it has really been a non-factor in pharmaceuticals.
Great, thank you. What are your thoughts on the recent CRISPR patent ruling, broad versus CVC?
I think, Jeff, you take that.
Yeah, sure. So honestly, I think it's actually going to have very minimal impact on the companies involved. You know, with these types of arrangements where Academic universities hold patents to particular technologies. Generally, some royalty is due back to the patent holder, but generally in the single-digit range. So, it may just mean that companies that were paying Berkeley are now just going to be paying the Broad. So I don't think it's actually going to be having such a significant impact on the players in the sector.
Thanks, Jeff. Given your understandable plans to use more gearing, at what level and when do you expect your gearing to peak during this buying period?
I think let me maybe address that. Typically, our gearing for Volvo Healthcare Trust is between 95% and 120%. Right now, we are at 107. I think for Biotechnology Growth Trust, it is very similar. I think the gearing changes are most of the time actually driven by fundamental sales. So we have been selling some stocks, which have been appreciating quite a bit here recently, to actually free up some space for some of the dislocated opportunities. Max gearing will always be at 120%, and typically we will use privates up to 10%. So on the publicly traded one for both trusts, it will be like 110%. And I would expect here in coming weeks that I think the gearing will go slightly up.
Thanks, Sven. What do you think will be the catalyst for the bear market to end? With values still seeming to favor more favorable to growth and increasing political uncertainty, why do you think this bear market is likely to end?
Let me maybe address that and answer. We have answered it quite a bit in during the presentation. But typically, when I look back, what puts the floor into a biotechnology bear market? It never is that generalist investors are the first ones to get back into it. They are not present right now. Retail investors, they are not the first ones to turn it around either. Every single time a biotech bear market typically gets ended by a couple major biotechnology acquisitions. So this is typically what puts the floor in the valuation, which makes everyone wake up and say, wow, this sector is too cheap because Merck or Bristol Myers are buying right now. So this has typically in the past been the most important catalyst for a reversal. I think I can see one other one as well, which is unique to the current environment. I think the emerging biotech sector has been used as a hedging instrument by quantitative and factor-driven strategies. We see right now record high short interest in the biotechnology sector. It's for the ETF, the XBI ETF, it's as high as 80%. And I think the full shorting is significantly higher. And I think that reversal, once shorts get squeezed in the sector, will be very, very, very dramatic. And this is why I said before, you have to buy them while there's still volatility in the sector. This is when you can still find liquidity. Once things turned around, once you have an M&A acquisition and the short squeeze, it will the revaluation will be very fast.
Thanks, Sven. A question on unquoted here. When you buy unquoted companies, how quickly do you expect them to list?
Jeff, you want to answer that?
So generally, we're buying unquoted companies in what's called the crossover round. So this is the last private round prior to an IPO, and we expect the IPO to occur within 12 months.
Thanks, Jeff. And just moving on from that, how do you value the private or unquoted investments in the portfolio in a bear market?
Let me maybe address that. We do have an outside valuation firm, which does the valuation. So they are taking all the factors involved. So there is a third party valuation there. I think this is as well where our boards are very, very active as well, where our accounting and finance committee chairs, they will recheck actually the outside independent valuations, but they usually simply take them. So this is not, the valuations are not driven by OrbiMed, they are driven by outside valuation and by the outside valuation firm with the sign off of the board of directors.
Great stuff. What are the pros and cons of Moderna, as OrbiMed see it, as a potential investment?
That's a very interesting question, and I many times look. Moderna has been a terrific success, and you may know we have actually Tal Sachs working, the ex-chief medical officer from Moderna working at OrbiMed right now. I think Moderna is many times misunderstood, I think, by the market. Moderna is an excellent vaccine company, but I think the potential of applying mRNA technologies to cancer vaccines is overrated. So we as a firm don't view Moderna as the Tesla equivalent inside healthcare. I think they have made an incredible scientific progress here with mRNA vaccines. But I think in the near term, it will be limited to COVID. So we have probably seen peak sales from peak revenues from Moderna. And I think the need for booster vaccination will be greatly diminished, I think, in the future. So we do not have a position in either Biotechnology Growth Trust or Worldwide Healthcare Trust in Moderna right now.
And I think you've just covered off another question here about mRNA sector opportunities. So thank you. There's a couple of questions here on director shareholdings across the two trusts. I can answer that one. 4 of the 7 Biotech Growth directors are existing shareholders, and 5 of the 6 Worldwide Healthcare Trust directors are current holders of their respective trusts. Another question on the buyback and discount control policy as well. As correctly stated here, Worldwide Healthcare Trust has a discount management policy of 6%. So the company will step in and buy back typically. The last time that occurred was November 2016. And you can go all the way back to the global financial crisis for examples of the company defending that 6% position.
I think to highlight there, during the financial crisis, the Worldwide Healthcare Trust bought back more than 1/3 of the shares outstanding to defend the discount at 6%. And many of our competitors, as you remember, there the discounts were widening to over 40-50%.
Thanks, Sven. Another medical related question. So is Illumina still your preferred investment in the gene sequencing space? And what do you think of the multi-billion-pound or dollar valuation of Oxford Nanopore?
Jeff, you want to take this one?
So Charlie Steinman, my colleague who covers life science tools, would be probably better equipped to answer this question. We do hold Illumina in the Biotech Growth Trust. They are obviously not in the gene sequencing space. Unfortunately, I'm not as familiar with Oxford Nanopore, so I really can't comment on their valuation.
We have significant holdings in the diagnostics and tool space, but our favorite theme there are liquid biopsy companies like a Natera or a Guardant Health. Natera is one of the biggest users of Illumina instruments, but we think there are actually better derivatives are available in the tool space. And a good indication for that is, like, you probably know that Illumina wants to buy back their liquid biopsy company, Grail, and they are in a battle with the Federal Trade Commission there. And you know that the #1 sequencing company in the world, where they really want to be, is liquid biopsy. And there are a few really good options there, both in emerging markets and here in the United States. And we are well presented in both trusts in probably the most exciting next generation sequencing liquid tools company.
Thanks, Sven. Well, that takes us to the hour. I just wanted to thank the OrbiMed team again. We're out of questions now. And if any of the investors on the call would like to ask any further questions, please let us know. Email us at distribution@frostrow.com and we will endeavor to come back to you. Thank you.
Thank you so much, everyone.
Thank you.
Thanks, everybody.